Today we're going to talk about the 7 states that have very odd retirement income taxation rules that you need to be aware of. These could be huge if you're ignorant about how these rules apply to you if you plan on retiring one of these 7 states. So welcome again to the Heritage Wealth Planning YouTube channel, Heritage Wealth Planning, the place where you come to find out about your taxation in retirement, as well as everything else financial planning related. We talk about everything here at Heritage Wealth Planning. So don't forget to subscribe right there, that little red button for subscribe. And then more importantly, maybe after you subscribe, is hit the little bell down there to be notified of future content. Because we do about 5 episodes a week, if not more. And you want to be kept apprised because lots is going on in the overall tax world. Every year it changes. And if you're not kept aware, you could, it could haunt you, that's for sure. All right, so let's dive right into it. So you know where I always start off with, I always go to the Kiplingers, and you can see here is a Kiplinger's map, and then I go to smartasset.com, and here you got their little map about states that are tax friendly or whatnot. And as I was doing my state by state retirement income for retirees, state by state, how retirees are taxed in every single state in the union, I came across a couple very interesting tidbits. And I also use a tax foundation. The drawback about the tax foundation, they just kind of give you an average and they don't really dive into the details as much as I was like. So we're going to start with Alabama. So if you have a pension, private, I'm just looking at my notes here, a private pension or even a public pension, but in private in particular from, like USAA or Chevron or something like that, you don't want to roll that over if you retire in Alabama. And the reason being is because they tax your 401k and your IRA, but your public and private pensions are exempt. In fact, let's go here. And this is from the website on Alabama, revenue.alabama.gov, the Department of Revenue. It says an incomplete listing of companies that have notified the Revenue Department that their pension plans qualify as a defined benefit plan. Beginning January 1991, any benefits received from a defined benefit plan are not taxable. So, and it gives you this huge list of companies. AFES, you can go through 3,000 on here, and it says very explicitly, this list is not considered to be exhaustive in any way. So, if you're working for, I'm just curious, let's see if Chevron's on here. I have no idea, but you can see Alaska, Teamsters. All this. I just used Chevron. It just came up to me. So we'll see if CH, there's Chubb. Yeah, Chevron. So Chevron retirement plan. So if you work for Chevron and you roll your pension into an IRA, you're wrong because you're going to get taxed in Alabama. Now, the tax rate in Alabama is not that horrific, but anything is more horrific than zero. Right here, the state of Alabama says very explicitly, any benefits received under a defined benefit plan are not taxed. So do not roll your benefit plan, your pension plan into an IRA. You don't do it to a 401k, but don't roll into an IRA in the state of Alabama. It doesn't make any sense. It doesn't make sense. So we want to keep your pension and annuitize that. Again, you got to look at your own scenario, but you want to see if you can annuitize it in order to generate tax-free income, because if you put into an IRA and take distributions out, it's fully taxed as ordinary income at your income rate in the state of Alabama. Something to really look into. Now, 401ks are also taxed as ordinary income as well. So I don't think very often, I can't really think of any reason why you take a defined benefit plan like a 401k and roll into a defined like a pension and roll into a defined contribution plan like a 401k. I don't know why you do that. I'm sure there's a reason. Just don't. If you're going to retire in Alabama, don't do that. All right, number 2, Hawaii. Hawaii is pretty interesting, actually, because Hawaii, they don't tax distributions that you're in your 401k or your IRA that your employer put in. Now, this goes back to 1996, but is very interesting, actually. This is from the Department of Taxation from the state of Hawaii. Let's see if I can find it. Not all retirement benefits are eligible for their exclusion in terms of what they don't tax. So right here, I'll just read. The Hawaii revised statutes state that certain kinds of pensions, whether paid by public or private employers, are not subject to the Hawaii income tax. But the issued in 1978, not all retirement benefits are eligible for this tax inclusion. And right here, if an employee invests his or her money in a tax-deferred annuity or an IRA, a distribution from that annuity or IRA is considered to be a return from an individual investment, is not considered to be an excluded pension. So basically, even your 401k, if you have anything, in fact, they talk about deferred compensation plans right here. Under an elective right to a plan, sometimes known as deferred compensation, a 401k, 457, distributions from the plan that are considered to be return of an individual investment do not qualify for the pension exclusion. Generally, the deferred comp plan is any plan in which the employee has a choice of whether to contribute money to the plan or take that amount as a cash payment. All right. So basically, again, and this section provides examples of deferred compensation plans that are not eligible for the exclusion. And they talk specifically right here about 401ks are generally funded by way of an election employee makes to have the employer make payments to the plan on behalf of the employee, or to the employee directly as cash. To that extent, such plans are not eligible for the exclusion, and distributions from plans are taxable. So if you have a 401k and an IRA in Hawaii, the amount that you put in there is taxable as well as a growth on those contributions. So essentially, at the end of the day, you got to think about this. If you have money that the employer put in, that money that comes out is going to be excluded to whatever the rule is in Hawaii. It's not subject to income tax. That's the rule. The amount that you put in the growth is subject to income tax. So a couple things jump out at me there. First and foremost, if you're going to retire in Hawaii, you want to make sure you understand the pro rata amount, or pro rata, however you say it, of what your contributions and growth was compared to your employer contributions and growth, because your contributions are subject to income tax and your employer contributions are not. It's pretty interesting, actually. That's a pretty unique thing that I bet a lot of people don't know. In some 401k plans, the employer makes matching contributions to the plan. If the 401k plan is funded by this type of contribution, part of the plan will be considered employer funded. An exclusion ratio will be used to determine the amount that is taxable or excluded, what they're saying. I mean, you got to understand that. So in Hawaii, very odd, and I'll put links to all these in the show notes here. In Hawaii, you got to understand that part of your 401k or an IRA, if you have like a SEP through your employer or something like that, simple. I don't really know that many people use simples anymore. But if your employer made the contribution, that is excluded from income tax. If you made the contribution, that's fully taxable. All right, so Michigan. Let's go to Michigan. Michigan had a weird one here. This is the exact opposite of Hawaii. So let's go down. What pension? So basically, Michigan gives you a lot of exclusions of qualified distributions. Subtraction is allowed on the Michigan tax return for qualified distributions from retirement plans. Retirement plans include private public employer pensions and IRAs right there. So that'd be your own. So if you rolled your 401k to an IRA, it's considered a qualified distribution. Several requirements must be made for an employer plan. An employee must have retired under the provisions of the plan. The pension benefits must be paid from retirement, and the pay must. All right, you can read all that. But watch this. Let's see. They had it down here. I got to see if I can't find it. What did not qualify? Let's see. It was up here. Right here. All right. So what certain distributions reported on 1099 are not considered pension or retirement benefits. And under Michigan law, these distributions are taxable deferred contribution. Tax-deferred compensation. Tax-deferred compensation includes all distributions from 457 plans are fully taxable as ordinary income. Distributions from 401k or 403 plans sourced to employee contributions. And that's actually the exact same thing as Hawaii. Now I think about it. So Hawaii was the employee contribution, same thing in Michigan. I think Utah was different. We'll get into that here in a second. But anyway, so Hawaii and Michigan, both distributions from 401k, 403b, and 457 plans that are sourced to the employee are not, and the earnings from those contributions, if the contributions are not matched by the employee, do not qualify for the exclusion. So again, you put money in, it grows. In a 457 plan, 401k, 403b plan, it grows. You take distributions out. That will be 100% subject to income tax in Michigan because you are the source of the value of that account. Now, if the earnings come from contributions made or matched by an employer, that's different. But just remember, you got to keep track of what comes out as you as an employee versus what comes you out as the employer contributions. Very important, actually. All right, Missouri is kind of odd, and it's just actually pretty simple. I don't even have a thing on it because it's easy. If you have your pension is not taxed in Missouri if your AGI is under the age on $32,000. So remember, AGIs are adjusted gross income. Now that might seem quite small because AGI is before you take any deductions or exemptions or anything like that. But if the bulk of your income comes from Social Security, you could have AGI below 32,000 easily. Because remember, a lot of Social Security, in fact, if all your income is in Social Security, you don't pay tax on that. Essentially, you don't have AGI. It's not really. You could have a little bit, but it won't be much. So the bulk of your income comes from Social Security and Roth IRAs. That's 100%. Your AGI is going to be zero and maybe a little bit to zero, which means your pension, as long as it's under $32,000, would also be tax-free, whereas your IRA and 401k distributions will not be. All right, so if your AGI is under $32,000, you pay no tax on your pension distributions. Now, pension distributions are going to add to that $32,000 that you have. So if you have, a penny of AGI and then you have $33,000 of pension income, well, your now AGI is above that $32,000 threshold. So just keep that in mind. But let's just say you have Social Security and Roth IRAs and your AGI is $10,000. That means you can have a $21,000 pension distribution fully tax-free. Social Security, pension, and Roth IRA, as long as your AGI stays under $32,000 as married, filing jointly, that's all tax-free to you. AGI is different than your actual income you're spending, though, because remember, actual income is what you're putting in your back pocket before taxes, before deductions, before anything. And so theoretically, you could have $1 million coming from your Roth IRA and your AGI is zero because Roth IRAs are not factored into AGI. You have, $40,000 basically from your Social Security benefits, $40,000 from Roth IRA. Your AGI in that case might be $6,000. No, it'd be 40. It'd be about 40. It'd be $3,000, which means you can have 29,000 roughly coming from your pension. Again, it's got to be a pension, not a 401k or IRA, and you'd be in a pretty good place there. That'd be all tax free. All right, so let's go to Maryland. Maryland's the big one here because Maryland boggles the mind how many people don't know this. Maryland pension exclusion is pretty fantastic. It's $29,900 per person. You get to, once you're over the age of 65, you get to exclude from your gross income if that income comes from a 401k, a pension, a 457 plan, a 403b, a qualified retirement plan. But what says right here, the subtraction applies only if you're 65 or older or totally disabled, or your spouse was totally disabled on the last day of the tax year. You included on your federal return income received as a pension, annuity, endowment from an employee retirement system. Please note that these include qualified defined benefit and defined contribution plans as 401ks, 401as, 403bs, and 457 plans. All right. But traditional IRA, Roth IRA, simplified employee plan, deferred compensation plans do not qualify. I don't know if that means they tax Roth IRAs. I don't know. That's the first I've heard about that. But it says right there, Roth IRAs and traditional IRAs do not qualify for this $29,900 exemption. It doesn't. And that's explicitly from MarylandTaxes.gov. That's not from old Josh. So you do not want to roll your 401k, 457, 457, 401k, 401a, 403b plan, annuity, or pension into an IRA in Maryland. It just doesn't make any sense because you're going to pay a heck of a lot more taxes than you would if you kept it there. In fact, there might be the difference between a whole lot of taxes or not. So just keep that in mind. Now let's go to Rhode Island. This is interesting because even on these two state websites here, Kiplinger's on top of that, smartasset.com and the Tax Foundation, they missed this one for Rhode Island, which I think is right here. Yes. So I want to show you Rhode Island just passed a new law just last year, 2017. You are eligible for the tax break, and the tax break is pretty significant here in the state of Rhode Island. If your federal AGI includes taxable income from pensions, 401k plans, annuities, and or other such sources. You have reached full retirement age as Social Security defines it. That'd be 66 if you're born 1959 or before, or 67 if you're born after 1960. You are eligible up to $15,000 per person as taxable to exclude from your taxable income. Pensions, 401k plans, annuities, and other such sources will escape Rhode Island personal income taxes. Let me just reiterate that. If you are eligible, which I'll tell you, up to $15,000 of your federally taxable income from pensions, 401ks, annuities, and other such sources will escape Rhode Island personal income tax. Now, what is the plans? The other plans: 401ks, 403bs, 457s, military pensions, government pensions, private sector pensions, and annuity distributions. So let's go down to page 8. And these are basically on income as well. So what is taxable? Is this page 8? This is page 6. Watch this, my friends. Page 8. Income from the following does not count. Right there. IRAs, my friends. IRAs. Direct rollovers of employees qualified retirement plan to another qualified retirement plan to an IRA. So basically, completed rollovers is an IRA. You're rolling from a 401k or a qualified retirement plan, a QRP, to an IRA. So basically, if you live in Rhode Island and your income, I think, is less than $100,000, married filing jointly, and I can't remember if that's taxable or adjusted. Off the top of my head, I can't remember. I did videos on that, so you should watch. But if your income is less than $100,000, married, I think it's $80,000, single, you can exclude all of $15,000 per person on these plans right here. You cannot exclude that on these plans right here. And so with Rhode Island having a pretty steep tax bracket, that's an extra $30,000 of income that you're going to pay tax on each and every year if you roll over your 401k to an IRA or any of these other things. So don't do it. It doesn't make any sense. So if you're going to retire in Rhode Island and it looks like your income is going to be less than $100,000, it'd be crazy to roll it over to an IRA. All right. So lastly is Utah. Utah is interesting because Utah does offer a credit. Now, a lot of people mix up credit with deductions, and they'll say, Utah credit's not that big of a deal. But taxpayers age 65 or older as of 31 December 2017, you may be allowed a retirement credit of up to $450. The credit is limited by the total of your modified adjusted gross income, non-taxable interest income, which is part of MAGI, modified adjusted gross income. And if a married couple finally jointly are both over 65 or older, they can claim a credit of $900. Folks, that is a dollar for dollar reduction in your taxes. So if you had a tax burden in Utah of $1,000 and you qualify for the credit, $900 of that is gone. You only have a tax burden of $100, which means 90% of your taxes to the state of Utah are just wiped off the mat because of the credit. But what doesn't qualify? Right here. Distributions from deferred comp plans such as 401k, 457 plans does not qualify. So here, if you live in Utah, you want to roll over your 401k to a IRA because distributions from deferred comp plans do not qualify for this tax credit. Jeez, this is crazy. Qualifying income is pensions, annuities, or taxable retirement Social Security benefits. To claim the credit, you must have earned the qualifying income. You cannot use pension, annuity, or Social Security income of your spouse as your qualifying income. The following are retirement income: amount paid from an annuity contract, basically a pension plan, amounts paid by the United States, another pension plan from the Govs, amounts purchased by an employee under a plan that meets IRA plans, tax retirement. So basically everything that you have that's an IRA or a pension qualifies for this $900 credit. If it's a 401k, it does not. It does not qualify in Utah. So unlike Rhode Island and Maryland, where you don't want an IRA, in Utah, you don't want a 457 or 401k. Crazy. So just remember, Alabama, Hawaii, Michigan, Missouri, Maryland, Rhode Island, and Utah all have little tricks that you got to be aware of. And you got to keep track of this stuff too, because as much as I like, some of the websites that we have out there, they missed the one for Rhode Island. One missed the smartasset.com, but the one from Maryland, you just got to look into your specific state. So what I do is I go to if I was getting ready to retire and say Montana, type in, does Montana tax retirement income and just follow what they say on their .gov, or this is taxslayer.com. But I definitely, it's preferable to go to, like in Utah, not Utah, Maryland, we're at the preferable to do that. In Rhode Island, I think it's Rhode Island, yeah, .gov. You want to go to the places .gov because that'll keep you up to date. All right, my friends, I hope this helps. Just remember those 7 little tricks that might be able to save you a boatload of money. Again, don't forget to subscribe down below. Hit the notification bell for sure. I'm always interested in comments, so put them down below. I need comments. It helps me get this stuff out there for YouTube land for other folks to see. And don't forget, with comments, thumbs up as well. Thumbs up are always helpful. And if you want to learn more, go to my blog at heritagewealthplanning.com. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.